A 50-year mortgage was just announced by Trump to help people afford homes. This will help by stretching the payments from 30 years to 50 years, therefore lowering payments. This sounds great, right? Well, there's just one big problem. It's called math. Just like in my classroom, I won't get political. I'm just going to go over the numbers here and see if it's a good idea or not. And I will just straight up dismiss the issue that even if you buy a house at 20 years old, which is unreasonable, by the time you buy the house and it is paid off, you'll be 70. The average life expectancy in the United States is 78. So you would not only own your home for just a few years, but you'll be dead shortly afterwards, you know. And what happens if you buy your house at 30, which is closer to average age? You'll be dead before the loan is paid off. And banks hate that deal. Why would they want to lend to someone and they're going to be dead before it's paid back? Even though it's illegal for them to deny the loan for that reason. Regardless, it's still a bad deal for them in a way. Let's get into the details of the math. And currently, the popular loan term is 15 years and 30-year terms. Pulling up this loan chart, you'll see here, I have some average rates that we're just going to use for these calculations. And you see for a 15-year loan, it is 5.61%. For a 30-year loan, it is 6.26%. The longer the term, the higher the rate. This is due to the increased risk of the loan. I'm going to keep things simple here. Let's just say a $400 loan is what you're going to take out at a rate of 5.61%. Your payments will be about $3,291.73. Note that by the time you pay off this $400,000 loans, you have to pay $192,000 in interest, nearly half of what you originally borrowed. So you're paying back a large sum of money. So the total amount you would end up paying for this $400,000 loan is $592,000 in total. Now, let's look at the 30-year option. It definitely lowers the payments to $2,465.47. That's about $826 less a month. It makes this house much more affordable, or an option that people like to do is now you can buy a more expensive home, more room, more things, more bells and whistles, and keep the same payment. But notice something here. If you look at the payment chart and interest payments that you paid, your interest payments now exceed what you initially borrowed. So you're borrowing and paying back a larger sum of money. Now, there is a jump from a 15 to a 30-year loan. You've seen how much you paid back, and you see the interest rate increases, and you can see the drop in payments. So what happens when you expand this to a 50-year loan? Rates will go up again, probably to about 7%. We're just going to keep it a flat 7, keep it simple. And maybe we'll see if we can lower those monthly payments about $800 a month again. And do the math, it comes out to $2,406.75. So this will initially roughly lower the payments by only $60, but yet you expanded the term 20 more years. See, there's a problem here. This doesn't make sense on the surface. But if you look at the term of the loan, the details, you're paying off this for so long, you barely pay anything towards principal. You're paying mostly interest for the most of the life of the loan. You pay over $1 million of interest, meaning that you pay over double the amount you borrowed initially in just interest, not principal payments. So you don't even pay down your principal payment, looking at the schedule here, till after 40 years. So it'll take you 40 years just to pay down the loan $2,000. That's crazy. Okay, even if they say, hey, the rates won't raise that much, 50-year loan, we're just going to keep it at the 6.26 rate, which would be unreasonable because the risk of the loan, the higher the rate's going to be. But let's just keep things simple. Let's say it doesn't change from a 30 to a 50, whatever. The payment would be $2,182.88. So you're saving roughly about $282 a month. Still savings, but only a slight savings because of 15 to 30 was a $800 difference roughly. And this one's only about 200 or so. It's not as much. So the only way the rates would actually be the same to make this possible is if the government would actually subsidize this, which that means raising taxes or moving tax money around to pay for these subsidized loans. So there's no such thing as a free lunch. So who would truly benefit from this? Well, maybe the home builders, they could build a little bit more homes. Maybe the buyers, they could buy, homes that they couldn't buy before, but now they're paying so much in interest. The banks now are taking a lot more risk and getting hardly rewarded it and maybe subsidized by the government. So they may benefit from this too because of all the interest, but really it doesn't solve the problem. It just kicks the can down the road and puts a Band-Aid on it and just makes a whole mess of things. But that's just what I think, and I'm just doing a quick surface level of all this. Let me know what you think, what is going to happen, if this is even practical, if this is worth it, because I'm seeing a lot of responses on the news about this. So let me know what you think, if it differs, and I'll see you next time on Business Discover, where we talk about all things business and finance. See y'all later.